Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia-Pacific on the up after optimism about Fed interest rate cuts are driving U.S. shares near record highs.
Investors watching for a possible breakout in Hong Kong's tech gauge in the opening minutes as well after Chinese stocks in the U.S. hit a 6-month high.
Also had Indonesia's new finance minister in the spotlight with a sudden removal of his predecessor, sparking investor concerns about the country's fiscal outlook.
And Chinese President Xi Jinping urges BRICS nations to unite in the face of tariffs, saying trade wars were disrupting the global economy.
Good Tuesday morning. Welcome to the program. And the story today is really similar to the moves we had yesterday, certainly with the Nikkei 225 doing similar moves to the upside yesterday. As you can see, extending that rally that's doing enough really to lift the benchmark. Of course, you're getting also some support coming through out of the big tech names like Taiwan. And certainly tech will be very much in focus as the Chinese market opens up. And I'll show you some of the big moves that we had in the overnight session. S&P futures, as you can see, were flat right now, following, of course, a relatively decent session, of course, overnight. Okay, perhaps underpinning this move back into risk, back into EM, back into the Asia Pacific is the dollar index. Bloomberg dollar index actually hitting a 6-week low. In fact, it's taking out some key levels to the downside on BBDXY. So as you can see, a nice round number 1200 has also been taken out there. The other thing to track as well is this relatively big move to the downside or flattening of the curve. 530s overnight. The 10s are coming up on your screens very, very short. If you're curious where we are, I think it's 404 was the last quote on the 10-year yield. There we go, 404.45. Okay, as promised, the Golden Dragon Index, you have Baidu, I think it's have Alibaba and JD.com, if memory serves me correctly. Yes, there we go. Thank you so much. And these are some of the names we'll be tracking going into the open today. Apart from this, insurance, healthcare, Citi upgrading that on the back of some policy support. And going into the open today, we are looking at a decent, and I'm being extremely generous with that, 179. And of course, dollar China on the back of dollar weakness took out 712. And of course, the fixing has been hovering near lows going back to about November of last year. Don't be surprised if we get something similar. And of course, this rally in focus with the southbound flow, I think it's 7 days now, Yvonne, coming back here into Hong Kong.
7 days of net buying there is quite a streak and certainly one to watch, right? You talked about Alibaba, you talked about Baidu. Those two stocks really have been the #1 choice for a lot of investors out there here right now. We'll talk about that a little bit later on. But yes, we're watching some key levels for HS Tech as well. The breakouts that we've been seeing, we'll be talking to CLSA, Laurence Balanco about that as well. What he's seeing technically, MPC Standing Committee, that's certainly one thing. The yuan fix as well, one thing to watch, just given we have seen when it comes to the offshore rate there, it's about 100 pips below the close for the onshore rate. So might we get some pushback from the central bank today at the fixing? We are in that window for credit data. Of course, the trade data yesterday did show a bit of course, weakness once again when it comes to exports and really what we've been seeing in terms of U.S. orders as well. And then we have stocks, right? We talk about tech, Capricorn, SMIC, A shares all in focus today. The A shares for SMIC resuming trading later on today. So certainly that's one thing to watch here as well. Keep in mind there's also a press briefing at the top of the hour when it comes to anti-involution. So certainly one thing to watch in the next hour as well. But it brings us, to the whole discussion about where we are in this equity rally, especially when it comes to the U.S., right? I believe there's been, 21 all-time highs already. JP Morgan, the trading desk, had a very interesting call. But if we, in fact, see the Fed deliver with that rate cut next week, perhaps we might see a bit of a pullback here.
Yeah, maybe a sell in the news wouldn't be a big surprise, given the fact that all the unknowns right now, well, all the knowns are being factored in. Rate cuts, and of course, you've had this rally, concerns over concentration and valuation. So we could, I'm not saying we won't get a catalyst, but it's not visible at this point in time. Although you look at the other side of the trade with the dollar moving to the downside, and you are getting more signs of, a breakout in many parts, excluding the United States, I guess is the point there.
Yep. Okay. Certainly that's one to watch, as well as Indonesia, of course, right? With the ouster of the finance minister yesterday. We certainly saw Indonesia assets react to that. Just the rumor itself, that's before markets close. So we'll see when Jakarta opens up this morning as well. Let's bring in Mark Cranfield, MLI strategist. He joins us now from Singapore. Mark, obviously there's a lot of talk of where we are in this U.S. equity rally. Maybe you can chime in on this whole J.P. Morgan debate on whether we're heading into a Fed rate cut at a time when it's the worst month of the year for U.S. equities, seasonally speaking here. Might that be a risk?
I wouldn't be surprised if there's something in what they're saying, in the sense that there's probably going to be a knee-jerk sell-off that once the Fed actually, unless they go by 50, let's assume they go by 25, which is fully priced into the market by now. You wouldn't be surprised if the market sell off a little bit in a typical knee-jerk reaction, the fact that it's actually happened. However, this time around, the outside voices are going to be pushing the Fed for more rate cuts. Whatever they do in September is unlikely to be the end of the story. So if there is a pullback in U.S. equities, it's probably going to be pretty shallow, because the narrative is going to be that the Fed still has a lot more to do. Given the data that we're seeing on the unemployment situation in America, you can say what you like about whether the data quality is good or not. That's what people have to go with. That's all the Fed and economists can see is the data that's being produced there. And that clearly is getting much weaker. It doesn't look as though it's going to turn around anytime soon. So we can expect that the poor employment report we've just seen is not the end of the story. There's going to be more of those coming along the line, and that's going to keep the pressure on the Federal Reserve to push for even lower rates. So that narrative about the Fed story driving the equity market, that is going to be with us for some time. It's going to be helping the bond market as well, keeping the US dollar lower, as you were talking about earlier. All of those things coming together mean that there isn't likely to be a significant correction to U.S. equities for some time. They can keep this rally going probably towards the end of the year.
Mark, there's a lot of talk now about what we're seeing across these markets in Asia, right? I'm talking 44,000 level that we've broken above for the Nikkei 225. China, tech continues to see continued gains and momentum. Southbound flows have been up for 7 straight days now in terms of net buying. Are we seeing a bit of a breakout in some of these markets that, people are really starting to notice now?
Yeah, and there you are. I mean, if you are at all nervous about the valuation levels in the United States, you have very real alternatives here in Asia. You have Japan and China, 2 very large markets that can absorb a lot of money. And the yen is relatively undervalued. The Chinese yuan, to some extent, is, but at least the central bank is keeping it on an upward path. From a foreign investor's point of view, both of those markets have a lot going for them. So if you are thinking that it's time to move some money away from North America, clearly China and Japan are a pretty compelling story, and they probably on a global basis don't look as though they're overvalued at all. So there could well be more to go on both of those markets.
Stephen Jen from Horizon had a pretty interesting take about the strength that we're seeing in the Chinese currency. He says, look, 6 could be on the horizon for dollar China here, given that policymakers are feeling the pressure to maintain a stronger currency. 6 seems a bit ambitious. I mean, does that look realistic to you at all, Mark?
That would be a very long-term horizon. The PBOC is being pretty careful here. It's very gradual, incremental movements that you're seeing. The way they're shifting the daily fixing is by pretty modest amounts. It's the process seems to be very calibrated. They've still got to talk with tariffs with the United States. Just because they've got a pause at the moment doesn't mean to say that those talks couldn't be restarted at any time. The United States suddenly could change their mind and want to talk again. So it's a delicate situation for China. Plus, they're trying to move their economy away from the U.S. consumers as well into other areas. They wouldn't want to strengthen the yuan too quickly. To get to 6 will take it doesn't mean to say it can't happen, but it will take a very, very long time. I don't think it's anything that you would make traders won't be betting on it reaching 6, let's say, in the next few months. They might in the next 5 years, but that's the kind of timeline that we're talking about. The PBOC is very comfortable with gradually moving the currency, but they probably don't even have a particular target in mind. They just want to keep it strong and stable and keep it on that path.
Yep. All right, Mark. Thank you, Mark Cranfield there. We'll see how that fix plays out here later on today. As we were talking about, right, is it time to look outside the U.S.? And we are starting to see potential momentum in really these big markets, right? We talk about the tech space. We talk about Japan here as well. That's why we're here from CLSA. They're saying it's time to rotate out of U.S. If you're wondering whether it's time to kind of spill over to small caps in the U.S. and whether this rally can broaden out, they said no. Focus on internationalization of what we're seeing across asset allocation right now. Breakouts in Asia are continuing. Let's bring in Laurence Balanco, technical analyst at CLSA. And they say, look, unleash the dragon, Dave. We have the dragon himself, I guess.
yeah,
Laurence Balanco joining us today.
The long himself in Mandarin, of course. Laurence Balanco is here to really, I think, the thesis is really, I think you and Mark just really laid it out quite nicely, right? The weakness in the dollar. Yes, you're getting highs in the U.S. market, but you're also getting to highs across many parts of the world, right? And when you look at, and Laurence going to bring you in here, right? So what we've done is we've put this chart that you've highlighted in that report, Unleashing the Dragon.
Yep.
It's a ratio between world ex-US and the NSPY.
Yep.
And as you can see, this has broken the hearts of many EM investors over the years.
Absolutely.
Why do I?
Of pain.
Yes.
Yep.
So why is this time different?
Well, I think the important chart is also the dollar index, where we've seen a clear breakdown below the 100 support area, and that suggests that you've seen the dollar put in a major 14-year peak after a bull market. So I think part of the attraction to international markets is this weakening trend of the dollar. And then the chart that you're looking at on the screen here, does highlight the 23% outperformance by the rest of world markets from the start of this year.
Yep.
We had a bit of a pullback from April to August, but that has hooked up, and it's actually stayed above the 200-day moving average. So we've got all the evidence building that we're getting these confirmed changes in longer-term trends. So I think that's the important chart to bear in mind, besides the absolute price action, which is quite exciting to talk about too.
Yeah, and what we didn't put in, but to your point, right? There's a moving average that's actually quite noteworthy here.
Yep.
That's actually bounced off that.
Correct.
If you could explain that purple circle for us in a moment here, and what that actually means, that breakout. And yes, we do have a moving average. That's actually not there, but what is the significance of this move? And
so
why is it different from what we've seen from other parts of the time?
So basically, we've got this 200-day, which we tested in August, early August. We've bounced off that. So if we think of the behavioral psychology behind this move, is that declines are getting bought in the rest of world markets relative to the S&P. So we're getting a change in that behavior. And this also represents the change in the downtrend that you've had for 15 years, where we're starting to get this series of higher lows developing. So there's a bit more evidence that I think some investors do want to see. But the evidence that we're gathering from the dollar index, from the relative charts and the absolute charts of international markets is encouraging that this is a sustainable and significant shift from a global standpoint and allocation standpoint.
Yeah, there we go. More evidence, as Laurence is pointing out, is in the report. We'll talk more about the evidence in a moment here. For now, Laurence making the case it's more a breakout than a fake out. Laurence Balanco will be joining us, of course, out of CLSA, technical analyst there. Yvonne.
We love when Laurence is in town because he stands there and he tells it like it is. All right. We're going to turn to our top story here this morning. We'll catch you later, Laurence. Turning to the latest when it comes to Indonesia, of course, after its finance chief was removed from office. And you saw how markets sort of reacted. Before that official announcement, there was some rumors that she would be removed. So we did already see the JCI fall as well. We did also see when it comes to the currency, there was some initial strength. We came off of that a little bit here as well. But certainly there's a lot of questions about what this cabinet reshuffling means. Let's bring in Faris Mokhtar there. He's joining us with the latest. Faris, tell us why this cabinet reshuffle happened in the first place, and why do you think Mwani was replaced?
Yes, Yvonne. So what basically is the trigger was the deadly protest some 2 weeks ago, which rocked capital city Jakarta, as well as other parts of Indonesia. Protesters had voiced grievances ranging from the lavish lifestyles of the politicians to rising costs. Now, with this cabinet reshuffle, what President Prabowo Subianto, who is actually going to mark his first year anniversary as leader of Southeast Asia's largest economy next month, is trying to show the Indonesian people that he is listening to them, that he understands where they are coming from, and he's trying to correct the course of his administration. Now, with the replacement of Finance Minister Sri Mulyani, as you pointed out, there have been speculations and rumors about her stepping down even since the start of this year. And it finally happened, and the market's still digesting the news. Now, with her replacement, the key question would be, is Indonesia losing someone who has, for a decade or more, guarded intensively the fiscal discipline of Indonesia? And that is something that the markets will watch with the new finance minister coming in.
Yeah, and Faris, David here, and I think just rumors of this eventually happening, and it did, of course, led to the drop in the JCI yesterday. I think the first thing I looked at this morning when I woke up was that ETF in the U.S. and similar, I think 2.4% declines. And I think the point you're making is quite significant and material. You know, what should markets expect from this new finance minister to maybe ease some of the nerves out there?
Well, the key thing is that, the difference between the new finance minister and the previous finance minister, Sri Mulyani, is in terms of the international standing. Sri Mulyani, is respected internationally and also at home. The new finance minister doesn't have that international heft yet, but he does have standing at home. He does have credentials. He's a trained economist. He has worked for former senior minister Luhut Panjaitan, who's arguably the most effective minister under President Joko Widodo, or his better known as Jokowi's administration, and he assured the public yesterday when he spoke to reporters. He said that he's a markets person. He understands the market. But what the markets and foreign investors and the business community will look out for will be, can he hold firm? Can he stand firm in terms of managing the fiscal on the back of President Prabowo's expensive policies, which are really quite costly? Can he hold firm, or will he bow down to pressure from the president? That will be a key marker. And so going forward, in the coming days, in the coming months, every comment, every moves will be scrutinized by markets and investors to see whether, he passed the test.
All right. Faris, lots to look ahead to, certainly, notwithstanding, of course, markets today. Faris Mokhtar, there, our Southeast Asia global business reporter, on the latest. In fact, just on this, at about the time the market opens in Jakarta, we'll be speaking with the OCBC's senior ASEAN economist on really where we go with this story from here. Right, counting down to the open of trade, 13 minutes away, Shanghai, Shenzhen, and here in Hong Kong. Again, as we're pointing out, are we looking at a breakout today? Possibly. This is Bloomberg.
Your remedy fix just crossing the terminal here this morning, and it is a strong one. We're talking about 7.1008 against the dollar here today. So certainly it is the strongest fix we've seen since November 6th. So Dave, I believe you were crunching the numbers. It's I think the third time we've seen such a strong fix from the central bank. Yeah,
if you look back, I think at the last, what is it now? So it's September 9. If you take it back about 11 months, we've only had 3 fixes at around a 7.10 handle. Today, one was during the U.S. elections the week of, and I think a week before. So it's fairly significant in that regard when you look at the chart here of the fixing of the day.
Yeah, and so that's going to be one thing to watch here. We were just talking about that Eurasian sort of call about 6, right? I mean, obviously that might be a long shot given what Mark was talking about, but you have the likes of Deutsche Bank, you have the likes of Bank of America saying sub 7 is actually possible in the medium term here, given what we've been seeing with the dollar weakness and, of course, the pressure to kind of keep the currency strong as well. Yeah, absolutely. Okay, so let's look at what that means, really, right? Because the dollar weakness really underscores many a thesis out there when you look at what's happening in equity markets. And let's continue the conversation with Laurence Balanco, technical analyst at CLSA. He still joins us here on set to talk us through. So we've laid out the thesis around there might be a case that finally, ex-US outperforms the US. Yep.
overnight, there was a big move in Alibaba, Baidu. I mean, name your Chinese tech firm, right? Talk to us about K-Web. Where do we go next as far as that story is concerned?
Yes, we're basically reinforcing the breakout from the 2023 to 2024 basing pattern. And we've recently broken out of the trading range that formed from the October 2024 highs. Basically, the bottom line is we've got another 36% upside. We think K-Web can trade over $50. And, like you mentioned, Alibaba, post its results, really reinforced its uptrend and breakout from the consolidation pattern that you've seen since March. In my presentation that I did yesterday to clients, you have about 6-7 slides where you just can flip through a number of these internet stocks that declined from 2021, spent 23 to 24 basing out, and we've now emerged from those basing patterns. And those are major basing patterns. Some of them suggest these stocks can trade up another 100%. So they made major bases in the China internet names.
That's amazing. You mentioned it's day one of the conference yesterday.
Yeah.
Are people getting more interested into this market, given this equity rally, this bull run we've seen so far?
Yeah, I mean, it's been great to see more international investors coming through, re-looking at China, having been underweight for a number of years. And even some clients that were in Japan last week are saying, that's where we went to while China was underperforming, and now we gained the other way, taking some money from Japan even. Not that I think, the charts in Japan are bad. Yeah, we've actually got major breakouts in Japan too. But as that incremental dollar, and I do think it's trying to find a home in China right now.
Okay, we'll have more with...
we'll have more. He's sticking around and just sprinkling us all his expertise and charts throughout the shows here. Lawrence Balanco, technical analyst at CLSA. Take a look when it comes to the pre-mark here this morning. It looks like we are still seeing a pretty decent kind of showing when it comes to, there's a trading debut in Hong Kong as well. Da Hong Tech. We'll talk to you about that as well. Hang Seng is up about 1/3%. We talk about that strongest fix since November here from the PBOC. We're at 712 levels for your offshore rate. We got plenty more ahead. This is Bloomberg. Some stocks to watch at the open. We're still watching the China tech space as well. There you go. Alibaba is up another day as well. We're up some 1%. This has clearly become the favorite among a lot of investors out there. The potential for AI for this company has really turned the stock into quite a darling here. $1.7 billion worth of Alibaba shares last week were traded through the Connect, right? So spending more than any other stock, that's according to our Bloomberg calculations. So Baidu is probably pretty close to that sort of metric as well. And we are seeing Tencent and JD doing very well as well here today. And of course, we also have, let's talk about bikes, foldable bikes.
Foldable bikes.
Dave.
Here's your Mandarin word for the day, 自行车. Just because I have to buy some time. That buys us about 10 seconds right now. On the up, there we go. On the upswing, we're up 50% on this trading debut here. In the city, I mean, you just do the reverse math from where it's trading right now, and you get the IPO price for that. But yeah, I mean, this is certainly underscores, again, for one, what's been a red hot, piping hot equity financing market here. And number two, of course, have been the flows, which underscores, of course, the earlier point we were making on a 7th day of southbound flows. And hopefully, at some point, that alleviates also the upward pressure we've seen on HIBOR, which is now at 3%. That's a separate conversation. Yeah, and then you have the strength in the renminbi. That also creates this whole kind of positive feedback loop in these equity markets as well, right? So there you go. Hang Seng is up about 1/3% as well. HS Tech is what really is driving that charge here as well. And we'll continue to watch H shares as well. Potential breakout for the H share market as well coming up. You're watching the China Show. The Open is next. This is Bloomberg. Good morning. Welcome back. You're watching the China Show, and we've turned slightly south on A50 futures, but as you can see on Hang Seng Index, I'm guessing this is down to some big tech stocks leading the way to the upside here. 25.7, 0.3%. I'm looking underneath the hood, but yeah, we are looking at again this divergence and this reversal of roles because it's been an A share market for several weeks up until recently, and now it seems to be the H shares are rearing their beautiful head.
They're coming back.
Yeah.
I got to thank Alibaba for that. I think it's really the tech space that's really driving it this way, where you have, the number of people really plowing this sort of money into the likes of Alibaba, Baidu, that certainly have really lifted this market. And as you mentioned, right, 7 days of net buying on southbound flows, that certainly does show momentum is on our side when it comes to the H-share and HSI here this morning. And maybe that's why we're seeing a bit of a pullback when it comes to onshore markets here right now. So CSI 300, we're down about 0.4%. Bonds are slightly in the green, but not moving too much as well. But we're watching very closely. SMIC. A shares are down 10%. They are resuming trade in the H-share market. We'll see how that pairs. But you are seeing quite a bit of a drop there when it comes to the chip maker here this morning. I mean, these were such big moves that we're seeing in some of these domestic chip players of late. So maybe there it is excuse there for some profit taking today. Capricorn Tech is also down just marginally by about 1/3%. We're watching very closely what goes on in Hong Kong. I mean, given what we've been seeing, there is a trading debut there. We're talking about Da Hong Tech. This is the world, one of the world's biggest, I think, the bike makers there, foldable bikes in particular.
But certainly the best performing one today.
I mean, yeah. You talk about the first day of school is looking really good for the bike maker as well. And it's kind of, it's a new genre, right? I think it's called leisure firms. I was reading there in the Hong Kong market. So certainly one thing to watch as well. HS Tech is up 1/3%. There you go. Alibaba's up, 1.5% once again. Tencent is also doing quite well. Baidu unchanged. Meituan heading opposite direction. So is Xiaomi. So it's a bit of a mixed picture here as well. But we are continuing to see some inflows into, of course, the H-share market. We're flat, but watching some key levels there as well. H-shares are up about 10.1%. You take a look, the fixing today was the strongest since November. So there is still that bias, I guess you could say, for maybe some slight appreciation in the currency. We're at 712 levels here right now. And we're watching very closely some movers like Apple suppliers, right? I don't know. I think it's 1 a.m. Hong Kong time. We're hearing from Apple with this big product event, expected to reveal the newest iPhone model, talking about 17, right?
Is it 17 now?
So the rumor is it's a slimmer version, and there's going to be improvements in battery capacity and in the front-facing camera. So just some slight sort of hints that we've been seeing from our Mark Gurman and, of course, our team there. But we've been seeing a lot of these Apple suppliers rally in the back of this. We're seeing a little bit of that coming off here today as well. But Luxshare has been certainly the standout among some of those Apple suppliers of late. China Health Insurance, interesting call there as well from the likes of Citi. So they're saying, given this sort of 5-year plan, anti-involution and the like, the one place to look at really is China Health and insurance stocks. So they've upgraded, or at least looking at specific stocks like Jiangsu Hengrui, Fosun Pharma, China Life, and Ping An Insurance in particular there as potential beneficiaries, of course, of this 5-year plan.
I'm glad you brought that up because top of the next hour, of course, we have this briefing that we're looking ahead to, and we'll see what they say, of course. They're talking about how this anti-involution conversation that's taking place and maybe some of the advancements in new industrialization.
Citi was talking about aging population and increasing insurance needs as part of this sort of plan. That's why they're looking into this.
There's your alpha. There's your alpha. We'll see what they say. And, of course, Goldman will be also joining us next hour to help us unpack what goes on there. But in the meantime, we're looking at markets now, headed back to charts, and still with us for some final thoughts. Laurence Balanco is in town, technical analyst at CLSA. He's been here, of course, for a conference. He's been presenting, of course, to clients. And I'm curious, the feedback, perhaps not completely under your purview, but what's the feedback you're getting as far as the technicals do indicate there's a breakout there outside of the U.S. What about the earnings story, though? Can you square that circle for us?
Yeah, I mean, I think for a lot of investors, and that they've come out to see sort of companies and sit in front of them is to try and sort of backfill when is the earnings going to back up the price action that you've seen. So potentially we've seen markets ahead of the turnaround in the earnings side. But you've seen some big gap ups. If I just look at the price action, for example, Trip.com or Alibaba, the reaction to its results, the market is re-rating on the back of that. So, results might not be stellar, but the price action is good. So it does look like the market's anticipating what wasn't as bad, and you're getting these trends develop, and they look pretty meaningful and significant, and the potential further re-rating from these bases that we've seen.
That's important.
You've been talking about the healthcare space as well. Is it more kind of like the rotation out of China consumption more into some of these biotech sort of names now that you're seeing? Or?
Yeah, so definitely the China consumer side, if we go through, the underlying components of that sector, it's very much more selective. The broader index has been underperforming the China market, so the MSCI consumer discretionary space has been an underperforming space, but within that there's one or two stocks that look attractive, and definitely healthcare has been a leader from April, breaking out early, leading the market higher, and last week we got a fresh breakout signal if we look at the broader index. So yeah, another key component that still looks like there's further upside.
Yeah, I mean, it's been underloved compared to tech.
Yes, absolutely.
Consumer discretionary. So where do you think that story goes relatively between those two cohorts?
I would say, so I think if you just single out China tech, so there's another ETF, CQQQ, which is the equivalent to the QQQs in the US, that is actually outperforming China internet, and that highlights the fact that it's more the tech-focused side that's outperforming the consumer side. Because the biggest difference in K-Web versus the China tech ETF is the discretionary names, basically. So that's one way you can sort of decipher, what's the key driver here. But to go back to the question of healthcare, I think that at least performs in line with the tech side of things. Yeah. And you also have the China clean tech story, which is also another breakout in re-rating. So those three themes, I think, healthcare, clean tech as well as broader tech is, I think, the key components driving the upside here.
Okay, you've been talking about breakouts. Tell us a little more about what you're watching in terms of levels for HSCI, H shares and the like.
Well, so HSCI is quite interesting. As you were saying earlier on, the A share market sort of got the limelight through late August into the start of September. And during that period, we had HSCI really consolidate below this 9,300 area. We've got this very narrow range that, we're on the cusp of breaking out to resume the uptrend. And that will give us, an upside target, immediate upside target of 9,800. But if I take a step back, just to put this into perspective, the 2022, 2024 lows formed this major double bottom pattern, and that suggests that ultimately the HSCI trades up to 12,000. So, that's the longer term story, and the shorter term story, a break above this 9,380 just reinforces that original breakout. So trend action, basically.
Yeah, I think you do see that double bottom on the index, on the price itself. So I think 12,000 takes us pretty much back to 2021 highs, right? Also forming a double bottom, actually, is one of your other charts, which might be similar here, which is when you do MSCI China against SPY. And I think we're going to bring that up as well. And you've also highlighted the double bottom there. We're bringing that up visually so our viewers can just help follow the conversation here. So what we've done is we put a ratio in, and there it is for you. So tell us, where does this chart go? What does this chart tell you?
Yeah, so I think, again, the message that we're getting from the price action in absolute terms for the HSCI, for the MSCI China versus the S&P, is that China bottomed in 2024. Okay. That's what the charts are telling us, is that having derated significantly from the 2021 highs, 2024 was the basing pattern. We've broken out of that, and that provides a platform for a continuation of the re-rating of China versus S&P, which you see there, which reflects similar to the world ex-US versus S&P, but it also highlights the breakout in absolute terms that we see.
How important a signal have volumes and turnover been for you? The fact that they've come back, and how much conviction can we place on that as far as the price action is concerned? Yeah,
I'll always go with price and momentum as my starting point, and I think that's 80% of the trade setup. But volume is just another reinforcing factor that's coming through there. And I probably think the important part for investors to sort of understand is the influence of southbound flows, now averaging over 30% of total volume in Hong Kong, is that we've really got a new market participant driving the market high, and maybe slightly different behavioral characteristics than we've seen before. But I think that's another key driver re-rating the Hong Kong market too.
What metrics do you look at for at least signs of overheating in this market? People talk about margin trading and the like. I mean, are there certain things that you look at?
We've got some internal sentiment indicators. We look. Some of our team look at the number of new accounts being opened on the mainland, and that's still not an extreme what we've seen before. So if you look at it versus the 2015 peaks, we're not seeing that extreme yet. Yes, it is picking up, but we haven't seen any of those extremes that'll get us cautious on it. The momentum indicators that we track are confirming the highs. So one of the things that I look at from a price action perspective is if you're making new highs and you're really seeing waning momentum, that's a sign of maturity. But what we're getting now is new breakouts and momentum confirming that.
Talk to us about Japan then, speaking of breakouts, because that wasn't on my bingo card. this week, the breakout, given, of course, there was a catalyst that we didn't really see in terms of the politics. But yeah, where does the Nikkei go from here?
Yeah, it's quite interesting because we broke out in July. We pulled back to that breakout area, which was around 40,000, and we've moved higher once again. And the trading range that we're referring to, or the breakout, dates back to the August 2022 lows and the April lows of this year. And getting through that 40,000 area suggests that Nikkei's got an upside target of 52,000.
Wow.
So, remember, that's one of the big weightings within the MSCI World ex-US. It's Japan and Europe. And I think Japan, having underperformed Europe late last year and the start of this year, is now starting to make back some of that lost ground versus Europe. So Japan over Europe too.
All right. Laurence, thank you. I think we covered pretty much everything, and then once things start breaking out again, we're not talking about acne and pimples here.
I was going to say, we're past our adolescent sort of era.
It's not a dermatologist conversation taking place here.
But yeah, certainly talking about breakouts in tech, Alibaba, the like here, certainly that's one thing that have been on the top of mind for a lot of investors. But yeah, if you want to go check out charts, everything else, GTV Go is where we're going to go. You can look at the charts, of course, the one that we just highlighted with Laurence earlier on, plenty of analysis there. And charts you can save as well for your future reference. All right, we're checking gold.
Oh, well, speaking of breakouts, here we go. they keep pulling me back in.
3,645.
New record.
New record. Certainly on what we've been seeing, the Fed rate cut seems to be a done deal here right now. There you go. New all-time high for the precious metal. Plenty more ahead. This is Bloomberg.
Welcome back. Some corporate stories we're following right now. We're tracking shares of Samsung, SK Hynix and there you go on your screens. After the U.S. proposed annual approvals for exports of chip-making supplies to their factories in China. Lots of information there. Now, it's a compromise really aimed at preventing disruptions to the global electronics industry, and it's after officials revoked Biden-era waivers that then let those companies more easily get such shipments. Now, Chinese EV giant BYD is ramping up its European expansion, unveiling new models and opening up more showrooms as it seeks to offset a bruising price war at home. Now, the company expects to operate over 1,000 stores across 32 countries in the region by year's end. BYD has also expanded its European lineup to 13 models, more than double the 6 it offered 2 years ago.
All right, sticking to some of the car makers and the like, well, President Trump's Made in USA push is hitting some speed bumps. Hundreds of people have been detained after a recent immigration raid at Hyundai and LG's EV battery venture in Georgia. It has exposed a contradiction in Trump's economic strategy, which relies on foreign companies to bring jobs and production to the U.S. Let's bring in Yo-Kyun Lee. She joins us now from Seoul. And this sort of story really highlights the challenges a lot of these Asian companies are dealing with when it comes to investment in the U.S., which doesn't seem to square with the visa policies that they have to undergo. Tell us a bit more about what's going on. Why can't Korean companies hire and train Americans like Trump said?
Yeah, so the President Trump's response to the latest raid was that maybe a Korean expert would have to train more American workers so they can work there. But I think it's important to note that a lot of these all of the detainees have been working at the construction and the installation of the machinery before the factories went up and running. So a lot of these people seem to be intending to return to home country once the installation was done. And if you think about the battery manufacturing, a lot of the expertise have been built in Asia, South Korea, and China. So installing and constructing these type of factories, which involves a very high-tech technology, requires years of experiences and expertise that can't be passed along overnight. So, but there seem to be the very limited option for these employees for the short-term business trips to the United States.
Now, Yo-Kyun, the other thing that this has sort of brought into the spotlight were the visa issues the companies are struggling with. How does this then go into that separate conversation? What do we now know about that separate issue?
Yes, so the visa policy has been in the spotlight since the raid because we still don't know exact conditions or whether these detainees have violated immigration law or not. But it looks like from the past practices by the Korean companies, a lot of the employees have been going to the U.S. for the short-term visa or the visa waiver program, which explicitly prohibit employment in the United States. But it looks like because of some of the because there were no exact alternatives that the companies could have resorted to, they've been using these visa waiver or the B1 short-term visa that allows attending conferences to send their employees for the factory construction and or for some short-term business trips, and that looks like to be the ones that in question. And however, for these companies and the workers to seek the longer-term work permit in the U.S., there seem to be a lot of restrictions and hurdles for them to navigate, we have to also note that these employees may not be needed in the U.S. after the construction of the factories are completed.
What does this mean for South Korean companies that are operating in the U.S. right now? Obviously, this is probably setting a chill across many industries. What's been the reaction so far?
Yes, from Seoul, the newspaper, the front page, have been carrying the photos of the Korean employees getting detained and shackled by the U.S. officials in Georgia, and that's been sending chill and anger across the nation. So I was looking at the poll by the local newspaper about 14 companies operating in the U.S., and more than half of them that said they may have to reconsider, they have to consider adjusting their operations in the United States, and some of them said they may have to postpone the construction or the opening of the factories. So this does have implication to their U.S. Investment plans. And remember, South Korea has pledged billions of investment in the United States just 2 weeks ago when President Lee Jae-myung met with President Trump for the first time. So we are expecting some hurdles and growing uncertainties about how the South Korean companies are going to operate in the United States. And one newspaper said that they might even consider it might be cheaper to build goods in South Korea and export to the United States than building those goods in the United States, given these growing uncertainties and hurdles that they have to navigate.
Yeah. A lot of decisions ahead there, it seems. Yo-kyung, thank you. Yo-kyung Lee there joining us from Seoul with the latest. We got plenty more ahead. This is Bloomberg. Some big stories that we're tracking for you this morning. Brazil's President Luiz Inácio Lula da Silva has condemned the use of tariffs as a form of blackmail. This comes as Chinese President Xi Jinping warns that trade wars are disrupting the global economy. Both men made the comments during a BRICS summit held against the backdrop of President Trump's targeting of the bloc's members.
Economic globalization is an irresistible trend of history. Countries cannot thrive without an international environment of open cooperation, and no country can afford to retreat to self-imposed isolation.
The U.S. has imposed sanctions on a network of cyber scam centers operating in Southeast Asia. Now, it's part of a push to pressure operations accused of using forced labor to defraud Americans of billions each year. The Treasury Department targeted 9 entities in Myanmar and 10 in Cambodia, where workers are allegedly forced to run virtual currency investment scams. The International Criminal Court has postponed a hearing on the confirmation of charges against former president of the Philippines, Rodrigo Duterte. Now, the court says the delay will allow sufficient time to determine whether he is fit to stand trial. Duterte faces charges linked to his anti-narcotics campaign, which left thousands dead.
All right, just a look across these markets. A lot of factors are now aligning for what is now, I just noticed, is the Hang Seng Tech Index at 5832. That's now trading at the highest level, in fact, since March 19 of this year. So we've taken out the recent high, which means we're now back to levels even before Liberation Day. So we'll see what happens with this. And as you can see, the drivers there are everything from the big tech plays, plus including, of course, the city note around some of the healthcare and insurance names that they think might benefit from the recent policy push.
If we're going to see some more sort of policies around how to at least help the problem with the aging population and maybe the needs of insurance there. So certainly that could be the play they mentioned there as well. But you mentioned, right, Alibaba Health's doing very, very well. But Alibaba itself, right, we continue to see sentiment over this stock. It basically used to be kind of like the one that was hit when it comes to food delivery concerns and the like. And now it's become almost like the best AI trade out there in China.
Yeah, it was the one that got away. And what now has been taken away is the 140 handle on Alibaba. So we're now looking at, this is obviously separate from Alibaba Health. 99.88 is the ticker there. We're now trading at 141 a pop. And I mean, which now begs the question, we're also at the highest level here since mid-March. And I'm looking at some of the technicals in this. And it does seem this is a stock that really has some decent, if not strong momentum behind it.
It really started with, I guess, the earnings, the surprise that we saw when it came to the AI-related revenue, which we saw a surge. And then on Monday, I mean, it had the big release of this open source AI model and co-led this whole funding round in a robotics startup. So there's certainly plenty of catalysts out there. And that's why we are seeing 141 for that stock right now.
Okay, there we go. And I guess speaking of cattle, we could see further more details coming through out of this briefing and happening in a couple of minutes, so stay tuned for that. Apart from that, the rest of the market looks good. Hang Seng China's doing this, 1.2% to the upside. Apart from this, also taking place this hour is gold hitting new highs. And, our guest this hour, Laurence Balanco, talked about the recent catalyst for gold was really this, he drove it back to the yield story.
It wasn't the dollar weakness, like he's like, basically, gold has been kind of in a trading range since April, and what really triggered it was what we've been seeing in the long end, right? When we started to see 30-year yields globally shoot up, that was the next trigger really for gold to shoot higher as well.
Yep, and of course, coming up in the next hour, we have a guest who can talk about, and the main thesis is there is some unintended concentration risk in your portfolio. So look at alternatives, and of course, we'll be talking about that, of course, with Russ, Ivinjack in a couple of minutes. Also joining us, of course, to talk us through Indonesia. That market opens up in the next hour is OCBC, and really where we go from here and what we need to look for from the next finance minister there. So we will have a lot more coming up in the next hour of the China Show. Stay tuned for that as most of these markets start breaking out of Zone 2.
Welcome back to the China Show. A look at the HSI half-hour session. We're all back at work. Seems like this typhoon is behind us here right now. And take a look at this equity market. Ooh, breakout could be in store here, according to CLSA's technical analyst, Laurence Balanco. They came up with a very interesting note about unleashing the dragon. When you take a look at the breadth, when you take a look at momentum breakouts in China and Hong Kong, they say, look, it's time to really look very closely at this broadening of these international markets. Don't focus just on the U.S., he says. Yeah,
look at Europe, look at Japan, look at China, look at Hong Kong. Buy international markets, not U.S. small caps. Is the thesis there out of CLSA when they look at the charts. And why not, right? You are getting some momentum coming through. The other conversation, though, that has yet to really align is really the earnings story and when that will eventually follow. I mean, not to also mention the earnings story has mostly been a Mag 7 story up until maybe recently where that started to fade. Torsten Slok had a very good, insightful note. I think it was yesterday that highlighted the concentration risk has been immense amidst an earnings story that's been slightly pulling back from the Mag 7 and into the broader market. So I think the thesis there is there still the same amount of reason and gusto to be in the Mag 7? That's for a separate conversation later on. Indonesia's opening up today, and right now, following what was really a terrible session going into the close yesterday, we are extending the declines there following, I think it was over a 1% drop into the close, plus a 2.4% drop in the ETF overnight. And again, the very fluid story as far as politics goes there.
I think it wasn't a huge surprise that the finance minister was removed. That was something that was certainly in speculation, but the fact that it has happened now raises a lot of questions about, obviously, the fiscal discipline into this economy. That certainly, people viewed Indrawati as sort of the defender of Indonesia's excellent debt profile. She had investors' trust. She was, seen as a sign of financial stability. So what does this mean now on overall the government and how they pursue and try to appease at least protesters on the ground moving forward too?
Yeah. Not that the new finance minister doesn't have a resume. Perhaps the argument for now is, I think the Indrawati was finance minister, if I'm not mistaken, 16 in the last 20 years.
Yes.
So the global investors have been very familiar. And it's almost like, I was thinking about this analogy earlier on, it's almost like breathing or your heart rate. Like, you're not supposed to notice it, right? It's the fact that you're not noticing your heart is a good thing.
Yes.
Right? No news is good news. And the fact that it's been a relatively steady story as far as that's concerned, and perhaps it could be changing, might be a cause of concern. And who knows, of course, where that story goes.
I think we were talking to our team, Indonesia, Bloomberg Economics, was, to talk about what led to this sort of replacement. And it seems like there was a bit of point of contention between Prabowo as well as Indrawati on, how much they could actually maintain that fiscal restraint in the face of these protests, right? When you're talking about cost of living, when you're talking about inequality in this economy. So certainly that might have been the ultimate trigger and what happened here, but a lot of questions there. Let's bring in our guest to talk about what this change means for the country. Lavanya Venkateswaran, their senior ASEAN economist at OCBC. She joins us now. Lavanya, it's great to have you. Can the government actually maintain fiscal discipline without Indrawati?
Thank you for having me. That's a really good question. And I think at this point, our answer is yes. We do believe that the fiscal deficit is not going to exceed the 3% of GDP legal limit. But the real question here is, how is the government going to rebalance the expenditure profile, and how is it going to create more revenues for itself in order for the government to be able to focus on these new priority projects? The pressure really has been coming from the fact that we've seen cutback in regional transfers. We've seen cutbacks in certain type of central government expenditures related to R&D, as well as conferences and so on. And I think there's a sense that there needs to be a kind of rebalancing. What's interesting is that CapEx, capital expenditures, have actually been still quite strong in terms of growth. So as we go forward, I think the way the expenditure profile is going to be rebalanced will be very crucial to understand where the fiscal deficit ultimately ends up.
Yeah, this Lavanya, David here, by the way. Thank you for joining us. This pendulum swing between fiscal discipline, not mutually exclusive, but the swing towards populist policies, for example, which tends to be the opposite of fiscal discipline, not all the time. Where do you think that middle ground should be, given, the current pain point of the economy, which is inequality?
Hi, David. Good morning, and thank you for having me again. I do think that there will be a little bit of give in terms of populist measures. I think there is an inherent pressure building for fiscal policies to be geared in that direction, particularly because we have seen anger erupt on the streets. The question is, how much give is there? Is there room to spend a little less on, say, the free meal scheme, or readjust for other flagship schemes in order to provide this give for households? It really remains to be seen the extent to which that will happen. But I think going into the second half of this year, our base case would assume that there is a little bit of rebalancing that comes in to the fiscal picture, particularly when it comes to some of these measures. And where I do think there will be a cutback is in CapEx, right? And I think that's why we do have a much slower growth profile for the second half of this year at 4.7% compared to 5% in the first half of this year.
All right, we have some lines now from BI here, the central bank in Indonesia. So they are talking about strengthening the stabilization measures via the NDF, spot and government bonds. Also, they said they have it in the market to ensure rupiah moves at a fundamental value. So this is on the cusp of what we're seeing here with the currency as well. It actually has slid about 1% on the back of this news of Indrawati exiting. So certainly the BI has been intervening in this overall. all, does this change the calculus at all for Bank Indonesia? I think Citi had an interesting call that you might have to delay that next rate cut from the central bank now.
Yes, I do tend to agree with that. I think against this backdrop, delivering another rate cut may require a lot more justification than necessary. So I think there is a very strong case for Bank Indonesia to wait and watch out this episode of volatility. And we do expect another 25 basis point rate cut from BI this year, but it's probably more likely towards the November or December meetings. Considering BI has monthly meetings, there is still some room to deliver this cut, at least when we look at the rest of the calendar year.
The new finance minister, Sadewa, talk to us about him. What do you understand about his credentials? He is a seasoned economist, of course, and I wonder, the reason I ask you that is, I wonder if the market's not giving him the benefit of the doubt here.
To be fair to him, I think these are big shoes to fill, right? And I think anyone who is coming into this position is probably going to be facing the fact that they're dealing with a legacy here. I think Sri Mulyani Indravati has been there 14 out of the last 20 years, which means, like you say, she's a very steady pair of hands. And when you're moving from something that you're so well aware of and you trust so much in to someone who is still relatively unknown, there are a lot more questions than answers. So I think in that sense, he has big shoes to fill. But to be fair to him, like you say, his credentials are strong. He has been chief economist of Dhanaraska Securities. He has worked with the government in many capacities in the last decade or so. So he does have experience. The question is, how is he going to bring that experience to the Ministry of Finance, particularly at a time where things are looking a little bit more challenging? Growth momentum is slowing. The focus is on the fiscal numbers. So I think it remains to be seen what approach he is going to take. But as far as his paper credentials go, he is strong, as you mentioned. But I think for anyone to come into Sri Mulyani's shoes, it was always going to be a bit of a sort of challenge.
Yeah, big shoes to fill, as you say. Lavanya, this is coming at a time when Bank Indonesia and the government were about to restart the sole burden sharing agreement and how to monetize state spending. What are the implications of this sort of policy, and what would make it a success without Indrawati now?
I think communication is key when it comes to these kind of strategies. So we do need to hear a lot more about the details of these strategies, particularly from Bank Indonesia as well as from the government, as and when they go through with it. We do know that these policies are probably here to stay until one of the flagship programs is completed. So there is room for greater communication to build, greater trust to build with investors. Ideally, a lot of this information should have needs to be provided upfront so that investors are well aware of what's going on, which will assuage a fair bit of risk when it comes to perceptions around the fiscal situation as well as debt.
Lavanya, do we need to talk about risk to sovereign ratings, or is that a story that's still far away?
I think, I think there's some pressure there, but it's not something that we expect imminently. And to be fair, Indonesia's credit ratings have been quite strong. We've seen that most of them are on a stable outlook, which does mean that at least for the next 12 to 18 months, Sadewa will be given the runway to prove himself as finance minister. But we do have to closely watch the tone of incoming policies, and particularly how they change the expenditure revenue mix in order for us to get a sense of what credit rating agencies could be thinking down the road.
BI continues to talk about intervening to maintain rupiah stability, Lavanya. I'm wondering, they've been through sort of FX volatility like this before. I'm just wondering, do they have the means to make sure to stem this decline as much as possible?
They do have FX reserves, which total about $150 billion. And I think, BI has been very communicative when it comes to their strategy in the markets. And it is to stem volatility, as you say. So there is a sense that during these periods of excess volatility, they don't want to see very sharp moves. And they are here to back up or try and smooth out these moves. Ultimately, they do have some firepower when it comes to FX reserves. But it's a question of how much of that card you want to really utilize, right? So if this bout of volatility, the sooner it passes, the better, honestly. So I think they're just waiting to try and ride out this wave.
Lavanya, thank you so much for taking the time. And yeah, you figure we won't have to wait for too long before we speak to you again. Thank you so much for the insights as well. Lavanya Venkateswaran there of OCBC in Singapore for us. And as we were just talking, Yvonne was just asking that last question. Of course, Bank Indonesia is intervening to keep the currency stable and will obviously be in the market. And it's not like this is a situation that is unfamiliar to the central bank, of course. They've been there in similar situations.
And they have been actually pretty good when it comes to actually maintaining that stable currency as well. So certainly one thing. But yeah, as Lavanya mentioned as well, the timing of that next rate cut might be in question now as well. Coming up on the China show, though, we're going to talk about Aon now joining us to discuss how investors are navigating Fed policy shifts, global uncertainties, geopolitical conflicts, and the unintended concentration risk that he says he's been seeing among some of his clients as well. Russ, Ivinjack joins us coming up next. This is Bloomberg.
Doesn't feel to me like the policy rate is extraordinarily restrictive at the moment when you look at risk appetite. And so, risk appetite is definitely, out on what I'd say is the more exuberant end of the spectrum.
Goldman Sachs CEO David Solomon there speaking at the annual Barclays Global Financial Services Conference in the U.S. overnight as well. Meanwhile, there's a lot of talks about where we are in this sort of equity rally, right? When you're talking about the S&P hitting, 21 records, all-time highs this year, are we heading into this Fed rate meeting with a rate cut seems to be 100% priced in? Is that going to be a bit of a danger? I think J.P. Morgan, the traders out there, they're saying, look, there could be a warning out there that there could be a sell the news sort of event as investors pull back. They see that as a pretty big risk there, just given how we are entering into one of the worst months of the year for U.S. stocks, and the Fed is cutting. Yeah,
that's September and October, and I think the fact that there is, even if you try looking very, very hard, there's no dry powder in terms of what the positive catalysts are, right? Yeah. Because when you look at the earnings story, good, but valuations are full. If we get more than 4 cuts priced, and that becomes a problem in terms of the economic outlook, right? And I think when you look at what's outperformed, right, the catalyst this week has been rising yields and the problems around fiscal health there. And gold's been reactive to that, right? It's broken out of this range since about, I think it's March to about July. And I think the chart that's coming up on your screens, if not already, is going to show you gold just a couple of minutes ago hitting a new record, right? 36.51. I mean, is this the case for alternatives given the U.S. equity market, while good, remains perhaps too good for its own good? Let's bring in Russ Ivinjack, Global Chief Investment Officer at Aon, to help us understand the conundrum of why too much of a good thing is a bad thing here, Russ. And how do you approach now, where do I find my returns?
Well, first off, thank you for having me. Really appreciate it. Look forward to spending a couple of days in Hong Kong with colleagues, investment managers, and institutional investors at our Wealth Insights event. Where do you find your returns?
That's the question you're going to get there.
Yes. You'll continue to see in the equity markets if you have a long-term horizon.
Okay.
But the key thing that we're emphasizing with our clients is this unintended concentration that they find in their portfolios because the equity markets have been so strong the past 5 years. And the top 10 names, if you're just in U.S., represents 40% of your portfolio. If you look globally, that's 20% of your portfolio. So you need to diversify, not only in equities, but also in fixed income, because you can't just be in government bonds and corporate bonds. You have to move out into securitized, into private credit, like direct lending, asset-backed securities, securitized credit. They offer pretty compelling yields at this point in time and help diversify portfolios.
Can you tell us how we got there? How did it become an unintended sort of concentration?
The unintended concentration is a result of the equity markets. One, coming out of COVID, all the fiscal stimulus globally that was put forth. And then you had a handful of companies perform incredibly well. And their valuations are up, but also their earnings are up. So they've grown tremendously. And investors, if you just held an equity portfolio, whether it was an index fund or an active manager, you did well. And so that unintended concentration, because of really the Magnificent Seven doing so well, if you take a step back and look at your portfolio, you are now dependent on about 8 names driving your performance.
Why look that far into alternatives? Why not still look in equity markets where you could make the argument, at least this year, there are other parts of the global equity market that are doing well? Japan, Europe's done well.
China.
Recently, China started to break out of recent ranges.
Well, we've always advocated to our clients invest globally in equities. But the key thing there is there's so much volatility and uncertainty that as this unintended concentration has come forward, you need to diversify. So we've been advocating not only what I talked about in fixed income, but also into infrastructure, private infrastructure. So utilities, transportation, renewable energy, data centers, helps build a ballast in a portfolio, or really more resilience. And then we've also advised clients to really look at diversifiers. That includes hedge funds, so relative value, global macro, and also insurance-linked securities.
What are your clients doing? I know you're here to talk and have a lot of meetings. Are they noticing the complacency maybe that you are seeing in the equity market? Are they de-risking right now?
There is a bit of complacency because you look at how well portfolios have done.
Yeah. Why change, right?
And you're saying, why change?
Yeah.
And what we try to call this, how do you minimize your regret of making that move into a new area?
Yeah. It sounds like dating advice.
Yes. And so that complacency has been built just a little because returns have been good in the equity markets. But yes, our corporate pension clients globally are in a good position. Many are 100% funded or more than 100% funded. So they've been de-risking, moving out of equities more into fixed income to match their liabilities. But if you think about U.S. endowments and foundations, they need more current income. They've been very heavily into private equity. They now, because of the volatility that we're seeing in the U.S., they need more current income to really meet their bequests. So those are the key things we've been talking to clients about. And also you just need the other thing, which we call get real. And it's get real is really making sure you have real estate in your portfolio and private infrastructure. So those real assets provide diversification.
Interesting, the concept you brought up of being able to meet current obligations, that goes into the broader, I guess, concerns of some investors over, what's the message, over illiquidity premiums. As you go into private markets, you'll need to deal with perhaps not being able to access your capital, or being, there's a price to pay for that.
There is, and that's why you expect a premium for moving into the illiquid asset classes like private equity, private credit, infrastructure. I will say that the investment management marketplace, or managers, have been innovating in terms of the types of vehicles that investors can access these investments for. So there's a bit more liquidity than we're used to, but careful planning in how you pace your investments in, as well as you receive the cash flows from those investments in their harvesting.
Right. I mean, there has been a nascent trend of securitizing some private market assets into the public markets. And I wonder...
It's very murky now, right?
Yes.
The fine line between the two.
Does that solve the problem, or does it make it worse? Like, are we forcing private markets to behave like public markets when we want to diversify out of public markets? Like, where's your head on that?
That's a great question. And really we see it's a continuum. They are converging, both the public and private markets. And that's why we're seeing vehicles include both private market investments along with public market investments. So institutional investors, and we're even seeing on the wealth side, or retail investors, having access to this because there is a bit more liquidity. You don't have to wait 7 years to get your money back. So there are mechanisms by which you can manage liquidity in the portfolios, and we see that particularly in private equity with secondaries.
Right. Russ, it's good to have you here in the region. Russ Ivinjack there, Global Chief Investment Officer at ION here in the Hong Kong studios. We got plenty more ahead. This is Bloomberg. Welcome back to the China Show. Here's some corporate reads or stories that we're tracking for you today. China's Unitree Robotics is reportedly planning an IPO that could value the startup at up to $7 billion. Now, Reuters says the firm also plans to list on Shanghai's technology-focused Star Market. Earlier, Unitree said it would submit filings to list as soon as next month, and the move could offer investors insight into the finances of one of the country's most prominent robot developers. Love this video. Temu is slashing prices to win back U.S. shoppers after President Trump's tariff changes battered sales. Now, Bloomberg data show prices on its top items are down 18% on average since April, with some cuts as steep as 60%. Now, the PDD-owned platform had briefly pulled back from the U.S., with its sales plunging over 30% during some weeks in June.
Yeah, font size 4. Trust us. There we go. We're increasing the font size to the normal, I think 16 is our standard, our 标准, for the market's graphics. And on your screens, there we go. A nice lineup of 7s there. Okay, property stocks in focus, and I think Country Garden's doing decently well. Today we're up 33%. Of course, we're trading in cents, so that's a relatively lower bar. Do we know why? Anyway, no, we'll try and figure out why we're looking at these property stocks. But again, we're just calling your attention to the fact that they're moving on the way up. Okay, yeah, I'm being told there's no reason, like many things really in the world, if you think about it. Okay, Vietnam is opening up after what was a very bad session yesterday, 2.5% to the downside. We are opening flat, if not slightly to the downside. Southeast Asia is very much in focus here today. And Indonesia, of course, which was trading up. It's now trading down. In fact, let me just check my screens very quickly on the JCI. The currency is certainly trading on the weaker side of things at 16.5. JCI actually opened down, flipped back mildly positive in the first 5 or 6 minutes, and then we're now at session lows. That was verifying. And of course, within that market, heavyweights within the Indonesian market coming up on your screens, and most of the financials, of course, coming through and maybe doing that pull to the downside, 1.5% there. And yeah, we've certainly the last commentary that's come through out of the Bank Indonesia was that they're going to be here to stabilize these markets, currency markets.
Yeah, ANZ had a pretty interesting note that came out a couple minutes ago. So foreign outflows from Indonesia likely there on this Moyani news there. They're saying BI can be expected to intervene. 16,500 seen as an important level to watch there. We got plenty more ahead. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break, and yeah, lots to cheer for there. Now you take a look at when it comes to this breakout, as some say, in Japanese markets, right?
44,000.
We're around 44. We did break above 44,000 earlier. We come off that just slightly here today, but we're still up some 90 points right now. Topics is flat, but really we continue to see a lot of momentum into this market here. You could say maybe the political instability there is actually leading to more flows back into Japan once again. 147.30 for dollar yen this morning.
Okay, this weak dollar story is really coming through, and in many ways, right? So I think the gold was one because the recent yield melt-up was really the gold story today. We're looking at EM, Asia Pacific, so that's a lot in Japan. Taiwan's doing well. It's also worth pointing out on your screens to South Korea, which is 2.5% from a record high. And also MSCI Asia Pacific is about 2.8%, if memory serves me right. Most sectors are trading to the upside. I haven't looked at volumes just yet. And of course, this Hong Kong market's actually doing quite well, with Alibaba last we checked picking out $140 to the upside. So yeah, we will leave these markets here for now. They're doing well, so why change a good thing, I guess.
Yeah. Continue on here, maybe until we get to that Fed meeting next week. Certainly is going to be the key fund to focus on. U.S. inflation print is next as well. Time for a quick look at what's making headlines in China's national newspapers. China Daily has published an editorial warning that the U.S. against taking a confrontational approach in their relations. The paper is reacting to a New York Times opinion piece by former U.S. officials who called on Washington to counter Beijing by strengthening its alliances. The editorial says China is not trying to challenge the U.S., but is seeking cooperation, and calls on American politicians to see China as, quote, one of the major poles in a multipolar world.
Now, in financial papers, the Securities Journal is reporting that the Commerce Ministry will roll out more measures to support services consumption. Timing? This month. The front page article says policies will open up some internet and culture sectors to foreign investors. Now, services that stand to benefit include camping, homestays, property management, and online healthcare. On that note, and speaking of policy briefings, we're taking you straight now to this live briefing taking place. The China's Ministry of Industry and Information Technology and briefing the media there. And the latest round coming through here is on semiconductors.
Yeah, I mean, the title of this briefing is quite long, right? Vigorously promoting new industrialization and strengthening the foundation of the real economy during the 14th five-year plan period. Oh. So there you go. We couldn't fit that in a strap, but no. Yeah. But the key thing, of course, is high-performance chips tech, right? So, just given what we've been seeing with NVIDIA and, with H20 and really whether, what NVIDIA's outlook is going to be for these Chinese market is still the key question here, as, of course, we have seen rhetoric from, China is to maybe not buy those chips, right? And maybe let's just work on our own. That's why you're seeing likes of Capricorn, SMIC. Oh. I mean, these are basically now the darlings, right, of this market right now, and why people are continuing to buy up these stocks.
And speaking of SMIC, of course, the other story related to that is the A shares are, I believe, trading today, resuming trade today. But yes, we are getting some upside when the chips are up, as they say, or the opposite of that is the story there today. But yeah, so far this is the only headline on the Bloomberg so far that's dropped. Not to say that nothing else has been talked about, but we will bring you more details as we do find out more, of course, coming through from this live briefing, which is a bit long in terms of the...
I won't say it again.
Vigorously. There.
Let's bring in Shan, the bank's chief China economist, joining us on set. When you see breakthroughs in high-performance chips tech in China, there's a lot of questions on how far we are, in China is in developing the next challenger to NVIDIA. I mean, is this something that you're looking at as an economist as well, or overall, how big of this whole self-reliance theme?
Yeah, I think it has two aspects. One is certainly the self-reliance, because China still imports quite a bit of semiconductors currently. So similar to food supply security, energy supply security, semiconductor supply security is certainly the direction for the government to push. And the second is from a growth point of view, whether it's a semiconductor, whether it's AI, whether it's robotics, shipbuilding, aerospace, all these high-tech areas, they have been a major driver of economic growth. Just think about China investment, right? Property investment down. What came up? Manufacturing investment. So from a growth and bigger picture point of view, that's also a very important pillar for China's growth model.
Have we seen employment also sort of flow into those new sectors? What's the employment picture looking like? And how is the shift taking place as well?
Yeah, employment data are not that great, so we can only provide some anecdotes. We know, AI-related jobs from some of the hiring platforms seems to be doing well, but the broader employment picture is not so much. If you look at all the PMIs, they have the employment sub-index. If you just look at those, even when we see the PMIs are doing okay, the employment component is not. So between you have a weak domestic demand and you have innovation, that's in part reduce labor cost and reducing hiring. So the combination of both is putting pressure on employment.
There was that local media report about expanding some of the consumption sort of stimulus we've seen so far to the services sector. How beneficial do you think that's going to be in turning around consumption?
Yeah, the government has been talking about this for a while, right? You hear about elderly care, you hear about the ice and snow economy, the sports economy, travel and tourist. So why is the government so focused on services? You break down GDP, right? China still has GDP target, want to grow the economy. Exports already very strong. Investment already very big part of the economy. And then that leaves the consumption. But goods consumption, we had the cash for clunkers or the consumer goods trade-in program. So what is really left that has a big room for improvement and boost growth is services. And this is where I think the government, why the government is focusing on services and relating to our conversation about employment, right? Services are labor intensive. So by growing services, you can also help alleviate that downward pressure on the labor market.
That's where the multiplier effect is going to come into play. So how does that then look? So it's easier for me to conceptualize a fiscal transfer to help goods purchases. Services, I have some trouble with that sort of abstract. How would that work?
This is a new area for the government as well. I think they're experimenting and figuring things out, right? The past few years, we saw some local governments sending out coupons, so you go to restaurants. So that's one example. And some local governments will have some kind of a festival, music festival, or some festival that encourage people to sort of spend time and leisure, and that's another approach. And then when it gets to, say, high-end medical services and certain education areas, I think the government may be also thinking about if we remove some of the restrictions from the supply side, not from the demand side, from the supply side, if we provide higher quality services in areas previously with a lot of restrictions or oversight, could that boost services? So my sense, reading all these documents and looking at what the government's doing, they're thinking both from demand and supply, thinking multiple areas, still an experimenting process.
And they probably needed to offset what potential sort of external threats, right? I'm taking with the trade data from yesterday, where we did start to see exports are starting to slow down. U.S. orders basically plunging for, I think, the 5th straight month now. Is the export picture, that pillar, really going to start to really shrink now for the Chinese economy?
If anything, I think the exports have been surprising to the upside, even though yesterday's data per se was a miss, because that's the nominal amount of exports. If you look at the real terms, the number of cars and tons of steel, we only have July data. July up 10% year-on-year again, with 30% tariff from the U.S. added this year. So the entire export picture has been pretty strong. But I do think the government is also thinking that as strong as exports are, we also need some domestic driver of growth going forward.
One of my favorite things to do on a Sunday is look at my email, because you guys put in this 3 things on China that comes through. And I think the second item this week was the inflation print that comes out tomorrow. And I think one of the observations you guys made was we might actually see the month-on-month PPI turn positive. Why is that significant?
If you're an investor, you watch the sequential month-on-month number very carefully, because that's leading, right? The young years take a few months for that number to materially change, because that 11 months is already baked in the data. If you look at the steel prices, coal prices, lithium prices, polysilicon prices, which goes into solar panel, the raw material prices did increase in July and August. So from that point of view, when you have upstream sectors price going up, whether on expectation or actually anti-involution related, if you already see commodity prices going up, that could translate into improving PPI sequential inflation. But for the young year numbers that pop up on your screen, that's going to take a while to get back to the positive territory.
So we are starting to see anti-involution in some ways making its way, right? Are we seeing it beyond just capacity cuts?
Those sectors,
we're seeing a mixed picture. We're seeing for the food delivery, the companies, they're communicating that the worst may be behind us. So that's part of anti-involution. We are seeing for the solar panel industry, our industry association is coordinating something. So we're seeing a mixed picture of certain actions. Chemicals industry, there's document coming out of the government. So this is still a very much wait and see for investors to figure out the magnitude of action and impact of such action.
Speaking of a document coming out, a document that has come out is this report out of you guys. The latest on internationalizing, that's another long word actually I struggle with, internationalizing the currency. I mean, it's a long process, right? You settle with trade, investment currency, reserve currency. Where do you think we are on that spectrum, and what's next to watch? Like, is this time different?
Yeah. You're exactly right that transitioning from one currency dominance to another takes a really long time. We mentioned in the piece that think about the Britain versus the United States, right? United States became the largest economy in 1870s, but the dollar didn't become the dominant currency until 1950s. So it does take a really long time for the currency handover. We're not talking. We think dollar dominance is here to stay. It's going to stay for a while. But if you look at the disconnect between China's economic share in global stage, right, around 15-20%, versus China's share in the global international finance is 2%. So there's a big disconnect, and we think there's room for that number to grow. China has been pushing for RMB internationalization for 15, 16 years now, but the progress has been very slow. Why do we write this report now? Between de-dollarization, another mouthful word.
You did very well, though.
And you mentioned gold. Look at what gold is doing, and part of that is the desire to diversify. And stablecoin, another innovation that introduces the challenges for monetary system. So all that complex make us think that this time might be different.
One thing people always talk about is in terms of the challenges is there the political will to loosen capital controls, right, when it comes to, this whole internationalization of the renminbi. And then there's a new thing, which is about stable coins. Might that be something that could disrupt the sort of kind of evolution that you're seeing?
Yeah, both are really important questions. I think the capital controls, some people would say that's a game changer. If you don't let loose the capital control, you can't really internationalize it. To some degree, that's right. But we also think that China's global share can it go from 2% to 4%? You're still climbing up on that process. So our view is that even with the capital controls currently in place, China's share in the global international finance could increase. At some point, if you want to go further higher, then perhaps the capital controls will become a problem, and China has to think about what to do with it.
And stablecoins? What impact?
Yeah, stablecoin, I think it's increasing the urgency for Chinese government to do something, right? China wants to build this ecosystem for developing countries and China to use RMB more, right? But if the dollar-denominated stablecoin is gaining market share, right now, vast majority of the stablecoins are dollar-based, right? So if that, the dollar's running ahead and allowing a lot of these developing countries to use dollar instead of RMB, that adds urgency for China to come up with alternative. We think the capital control is important for the government, so perhaps the offshore market, Hong Kong included, will benefit from China's push for RMB internationalization, because you want to keep that big onshore market intact and developing in the offshore market.
Fantastic. Yeah. Very, very well said. Shan, thank you so much. Chief China economist there at Goldman Sachs. We covered everything, including, of course, this massive push to internationalize. I did it.
You did it.
Yeah, the Chinese currency. We will leave it. We'll look at markets right now. 26,000 in the Hang Seng Index. I think I might not go for a haircut until the Hang Seng tops 29,000, but I'll think about it.
Get ready that Labubu costume, maybe.
That's 31,000. So it'll be clean cut David in a Labubu at 31. 29,000 will be Michael Bolton, David. Plenty more ahead. This is Bloomberg.
Michael Bolton.
Economic globalization is an irresistible trend of history. Countries cannot thrive without an international environment of open cooperation, and no country can afford to retreat to self-imposed isolation.
And that was Chinese President Xi Jinping addressing a virtual gathering of BRICS nations, and certainly Xi in Brazil's President Lula da Silva also condemned the use of tariffs as a form of blackmail. Our China economy and government editor Alan Wong is with us to talk us through what the takeaway was from this virtual meeting. What did they talk about here?
So the message from that meeting is a pretty familiar one if you've been following the events of the last week or so. These countries, they were all targets of Trump's tariffs, and their unified message is that tariffs are bad, and then they want to uphold multilateral and the global trade system. Lula himself, his Brazilian products face tariffs up to 50%. China faces about 40%. That's the weighted average. And then India also faces 50% for its purchases of Russian oil. So Lula called this tariff blackmail, and then China also used words like hegemony to describe, without naming the U.S. or Trump, these tariff measures. So the message is one of a united front against tariffs.
What does it mean for China, Alan?
For China, the BRICS countries, they mean something to China as a market for its exports, because we've seen just from the recent export data showing that China's exports to the U.S. declined 33% year over year. So China would be, and China's exporters would be looking outside the U.S. to sell some of its ware. BRICS country, as she mentioned on the Zoom call, basically, make up the world's 50% of the world's population and 20% of total trade. So it is a sizable market. But if he used that statistic to try to highlight the heft of this grouping of countries, it also shows that 80% of trade isn't happening among BRICS countries. And ultimately, that's precisely what Trump is using in this trade war, which is the power of the American consumer. And in leveraging tariffs on foreign products, Trump is trying to achieve his own political aims.
Alan, thank you, Alan Wong there on the latest when it comes to that BRICS virtual meeting. We're turning to Europe now in France, where President Emmanuel Macron is set to appoint a new prime minister within days after the premier, François Bayrou, lost a confidence vote in parliament. Let's bring in our senior news desk editor, Balazs Pens, with the latest. I mean, it's the fifth prime minister in less than 2 years. It doesn't seem like, are there any obvious candidates out there?
Well, there are self-proclaimed candidates for sure for a job like this. But the question is whether Macron can find someone who can bring a sense of stability after this very, very turbulent period in French politics. And the crux of the matter is there anybody who can pass a budget? Time is of the essence. We have a big strike planned for September 18th. There are protests happening. Fitch will come out with this update on France's credit rating at the end of the week. So markets would really welcome a sign of stability. But just to show how difficult the proposition this is, the socialists offered themselves as a party that could lead the next government. Immediately the center-right and the far left said that would not happen. So candidates, yes, there are a lot of them, but who can bring together this very fractured, unwieldy coalition? That remains a question.
I mean, I had a look at the open on French bond futures. It doesn't seem like markets are particularly perturbed about this, but not to say that the worst is behind us, but is the worst behind us, largely speaking, or are there potential risks down the road here?
There are plenty of risks, and there's a good chance of volatility with all these events still coming up, and we don't know how this is all going to play out in French politics. There are calls for the two things that Macron does not want to do, early elections and his own resignation. At the same time, it looks like markets have kind of resigned to the fact that it's going to be very, very difficult to cut the French deficit. As you said, a lot of it is priced in already, both in fixed income and in equities. So if it's going to be just muddling through, that might be something that the market can take right now outside of another external shock. But there's a chance of further volatility for sure.
All right, Balazs, thank you so much, Balazs Pens, our senior news desk editor. We'll leave you with a look at markets, and we will say our goodbyes in the next few minutes. But stay with us. We still have a couple of minutes left. Okay, a brief look at these markets. Gold, all right. So certainly there's a listing to talk about within the gold space, but of course the gold price itself, and as you can see on your screens, the gold mining stocks, I haven't looked, but I'm sure Laopu Gold is also doing quite well, and some of the jewelers really as a function of this broad correlated cohort of securities. Gold hitting a new record, effectively, is what I'm trying to say here. Laopu
Gold, I got you, man, up 8%.
That's crazy.
Right now, so certainly crazy, that's one to watch. Zijing also is up here as well. We're watching the China property stocks. We were scratching our heads at what was going on, but turns out Country Garden was included in the Shenzhen Hong Kong Stock Connect, and there's also been a lot of optimism around the progress on its debt restructuring. So there you go. Country Garden is up 25%. Shimao as well is up double digits. But the likes of Morningstar say, look, if you're looking at any sort of major creditor agreements at Country Garden, it's all just pure speculation at this point. So maybe pouring some cold water on the trade here this morning, but certainly one to watch. And we're still tracking all the moves that we're seeing around Alibaba this morning.
Who would have thought, right? And we just talked about Alibaba, which is coming up on your screens in a moment. It is, if not already. There we go. So 142 is a level that we have. So we're actually very near the high that we hit back early this year. And let me just look at that recent high. So I had that very accurately for you. So we closed at 143.40 on March 18 of this year. So you do the simple math and how far we are. We're about $2 from that. Percentage-wise, you split that in half. And we're very close now to effectively recovering, the lost years of the last couple of years, right? So beyond that, we're back to levels last seen in 2021 here, as far as Alibaba is concerned. And who would have thought, right? We'd be here. But yeah, here we go.
And who would have thought it's the AI trade that seems to be underpinning all the sort of momentum around the stock route. Before it was all about food delivery and the competition between JD.com and Meituan. And the moment that the earnings came out and we saw that surge in AI-driven revenue, and then there's no talks of this new model that's been kind of flagged as well. It basically has been the big trigger here overall at Alibaba, being one of the #1 bought stocks among investors of late as well. That's it for us here on The China Show. We have Insight with Hassan Ahmed coming up next.